As the U.S. markets are currently closed for the weekend, Opendoor Technologies, trading under the ticker OPEN, last closed on Friday, September 19, 2025, at a price of $9.57. This represented a notable intraday drop of 3.72%, a move that saw the stock fluctuate between a high of $10.28 and a low of $9.35 on exceptionally high trading volume. That final closing bell figure, however, masks a far more intricate and tense story playing out behind the scenes, one that pits a compelling futuristic vision for real estate against the brutal, unforgiving realities of the current housing market. While many investors see the recent surge in Opendoor stock year-to-date as a sign of a triumphant comeback, the underlying data and recent executive shuffles are painting a picture of a company at a critical inflection point, where the path forward is anything but certain. The popular expectation is that as a technology disruptor, Opendoor is poised to dominate the residential real estate landscape, making the process of buying and selling homes as simple as an e-commerce transaction. This narrative is powerful, and it has attracted a significant amount of capital from those betting on the long-term displacement of traditional real estate agents and processes. The reality, however, is that Opendoor's success is precariously tethered to macroeconomic factors far outside its control, most notably interest rates and housing market liquidity. The very model of an iBuyer, purchasing homes directly from sellers with cash, making minor repairs, and then reselling them for a profit, thrives in a stable or appreciating housing market with low borrowing costs. When mortgage rates climb, as they have, it dampens buyer demand, increases Opendoor's holding costs for the properties on its balance sheet, and compresses the potential profit margins on each transaction. The recent volatility in its stock isn't just random market noise. It's a direct reflection of this fundamental tension. The stock's dramatic run-up this year has been fueled by a broader market enthusiasm for tech and growth stocks, along with specific news like a recent CEO change that some believe will steer the company more effectively. Yet, the recent session's sharp decline on a volume of over 229 million shares dwarfs its average trading volume and suggests a significant institutional battle is underway. Large blocks of shares are changing hands, indicating that while some are buying into the turnaround story, others are heading for the exits, spooked by the company's latest financial disclosures and the persistent headwinds in the housing sector. This isn't just about whether people will adopt a new way of selling their homes. It's about whether the intricate financial engineering propping up this model can withstand a prolonged period of market stress. Many retail traders using platforms like Robinhood or SoFi Invest might see the year-to-date gains and feel a sense of FOMO. But professional investors on more sophisticated platforms like Interactive Brokers are likely scrutinizing the cash flow statements and debt covenants with a far more critical eye. Diving deeper into the recent market action, the stock's performance has been a whirlwind. After hitting a 52-week low near just 50 cents, its climb to over $10 has been nothing short of spectacular, representing a massive gain for those who timed their entry perfectly. But these gains have come with extreme volatility. We are seeing daily price swings that are not for the faint of heart. This level of movement attracts momentum traders, but it also signals a deep-seated uncertainty about the company's intrinsic value. The recent announcement of a new CEO was a major catalyst, sending the stock soaring as the market interpreted the move as a strategic reset. The expectation is that new leadership will bring a founder's mentality back to the company, focusing on disciplined growth and profitability. The reality, however, is that a new CEO cannot single-handedly change the direction of the national housing market. Furthermore, the departure of the chief financial officer shortly after this announcement introduced a fresh layer of concern, raising questions about internal stability and the financial outlook that new leadership is inheriting. Institutional ownership, while still significant, has seen some interesting shifts. Data suggests that while some growth-oriented funds have been adding to their positions, more value-focused institutions remain on the sidelines, waiting for concrete proof that Opendoor can generate consistent profits, not just revenue growth. This is a critical distinction many investors overlook. It is one thing to grow sales by buying and selling more homes. It is another entirely to do so profitably, especially when your primary assets, the homes themselves, are subject to market fluctuations. Fidelity Investments and managers of Fidelity ETFs and Fidelity mutual funds would be looking closely at the company's ability to manage its inventory and predict local market trends accurately, a task that has proven incredibly difficult for all iBuyers. For those unfamiliar with the core business, Opendoor Technologies operates as a leading iBuyer or instant buyer of residential real estate. The company's platform aims to simplify the home selling process by providing homeowners with a near-instant, all-cash offer for their property. This bypasses the traditional, often lengthy and stressful process of listing a home with an agent, staging it for showings, and negotiating with potential buyers. Sellers can close on a timeline that suits them, giving them certainty and flexibility. Once Opendoor acquires a home, it performs light renovations and then lists the property on the open market for resale, aiming to make a profit from the service fee it charges the original seller and any appreciation in the home's value. The business model is built on algorithms that analyze vast amounts of market data to price homes accurately and predict future resale values. The appeal is undeniable, offering a streamlined, digital-first solution to an age-old industry. However, this model requires immense capital to purchase and hold a large inventory of homes, and its profitability is highly sensitive to the accuracy of its pricing models and the health of the broader housing market. Past performance shows a company that has been incredibly effective at scaling its operations and capturing market share in the cities where it operates. Financial reports from previous years demonstrated explosive revenue growth, but this often came at the cost of significant net losses. The company was in a hyper-growth phase, prioritizing expansion over profitability, a common strategy for tech disruptors. The challenge now is transitioning from that phase to one of sustainable financial performance in a completely different economic environment. Those managing a self-investing portfolio or using tools like Schwab Intelligent Portfolios need to understand this history to contextualize the current stock price. Looking toward the future, the outlook for Opendoor is a study in contrasts, a landscape of significant opportunities balanced by formidable risks. The primary catalyst for a sustained upward move in the stock would be a stabilization and subsequent decline in mortgage rates. If borrowing costs come down, housing affordability improves, and more buyers enter the market. This would create a more liquid market, allowing Opendoor to turn its inventory over more quickly and with greater price certainty. An improvement in the macroeconomic picture is, without a doubt, the single most important factor for the company's success. Another potential catalyst lies in the company's ability to expand its ancillary services. By offering services like title insurance, escrow, and mortgage origination, Opendoor can create additional revenue streams from each transaction, making it less dependent on the slim margins from home flipping alone. This one-stop shop approach is a key part of the long-term vision. However, the risks are just as pronounced. A prolonged period of high interest rates or, even worse, a significant downturn in home prices could be catastrophic for the business model. If Opendoor is forced to sell its inventory for less than its acquisition and renovation costs, it would incur substantial losses, potentially jeopardizing its financial stability. The company's debt load is another area of concern that prudent investors with an individual brokerage account should monitor closely. Servicing this debt becomes more challenging if cash flow from operations dwindles. There is also increasing competition in the iBuying space and from traditional real estate companies that are adopting new technologies to compete more effectively. Do you believe the Federal Reserve will begin cutting interest rates in the next 6 months? Comment below with your prediction. In summary, the story of Opendoor Technologies is a fascinating clash between a forward-thinking vision and the cyclical realities of the real estate market. The expectation, fueled by a meteoric run in stock and the promise of disruption, is that the company is on a clear path to reshaping a multi-trillion-dollar industry. The deeper reality is that Opendoor is in a precarious position, highly leveraged to macroeconomic forces beyond its control and facing immense pressure to prove it can achieve sustainable profitability. The recent surge in its stock price seems to be based more on expectations for the future than on current fundamentals. While the potential reward is high, the risks are equally substantial. The high trading volume and extreme volatility are clear indicators of a market deeply divided on the company's prospects. For investors, this isn't a simple bet on technology. It's a complex wager on the future direction of the entire U.S. housing market and Opendoor's ability to navigate it. The path forward will require not just innovative technology, but flawless execution and a favorable economic tailwind.